So your tax situation, the assets that you sell, the length of time that you sell them is going to help determine what kind of capital gains income and therefore what kind of capital gains taxes that you're going to pay.
Hi, I'm Bette Hochberger, CPA, CGMA. This channel aims to educate you on tax, tech, crypto, and finance related news. Come learn how to grow and keep your wealth.
In this video, we're going to talk about capital gains. So, what is a capital gain? Well, a capital gain is when you have an asset and the value of it increases. Now, you might figure out that a capital loss is when you have an asset and the value decreases. This is really important to understand for my folks who are into crypto investing, in real estate, if you do a lot of stock trading, those kind of things where you're buying and selling assets. The capital gains is the type of income that you're going to deal with. There's two kinds of capital gains that we normally look at, a short term and a long term. So let's talk about short term first. Short term is 1 year or less. That means from the time you buy it to the time you sell it, it's less than 365 days. Now, again, the opposite. What is long term? It's going to be when you hold it for more than a year. So 366 days or more, and there's no real end to that or more, is a long-term capital gain. Now, when do you have these transactions occur for tax purposes? In the US right now, in our current tax situation that we have, you only are going to recognize income when you actually sell the asset. So we have two kinds of capital gains again. We have realized, and this is the taxable event. Realized capital gains are when you actually sell the asset. Now you might see reports, especially if you've got stock holdings or if you look at your crypto portfolio, and you'll see something called unrealized gains. That means if you look at the current market price, if you were to sell, that would be the sale price of the asset. But because you're not selling it and you're holding it, it's unrealized. So your tax situation, the assets that you sell, the length of time that you sell them is going to help determine what kind of capital gains income and therefore what kind of capital gains taxes that you're going to pay. So the way we calculate this gain, once you sell the asset, you take that sales price minus what you purchased it for. Sometimes we call it a cost basis. There could be other cost basis besides purchases. Perhaps you inherit property, something like that. But let's just, for simplicity, go with the idea of you purchased it. So the price on the date I sell minus the price on the date I purchased is my capital gain. It's the difference there. It's that appreciation in value or the increase in value. Or if it's a bad situation, the decrease in value. Hopefully we don't have a lot of those. There is one thing for my real estate folks, just in case anyone gets upset that I'm not mentioning it. You can actually add to your cost basis in real estate. If you take the purchase price of a property and if you've improved it, say you put on a new roof or you put in a pool or you redid a kitchen, those capital improvements, and see you have that word capital in there, those improvements to the asset actually increase your cost basis. So that calculation might be the sale price of the house minus the cost of when you bought it, minus also the improvements, right? So you have to make sure you're taking all of those things into account when you're doing a capital gain transaction. Now, how do we minimize these taxes? Well, the best way to minimize them actually is to take a look at their tax rates. Short-term capital gains currently are taxed at your ordinary income tax rate. So you might have to do a little bit of work to figure out what that means. For example, you might need to know things about your other parts of your income, like what are my W-2 income? Do I have other business income? What's going to affect my overall income level to figure out what tax bracket I'm in? And that's going to help determine how my short-term capital gains are taxed. Now, long-term capital gains use different tax rates, so it can be a little bit confusing, but it goes from 0 to 20, and there's only 3 of them. Now, this is really where you get the benefit because the biggest range is in the 15%. Most people I deal with for the most part, there's some outliers there, but most people are dealing in the 15% range. So it's often going to be a lower tax rate than it is for the rest of your income. And you're going to get there by holding it for more than a year. So whenever you can hold an asset for longer than a year before you sell it, that's the way to go to minimize taxes. Now, how does that play into the rest of your taxes? So if you're looking at a loss, this is really the part that's more interesting, I think, than the gain, because the gain, it's taxed at that tax rate. If you have a loss, you can only take a total capital loss each year of $3,000. So if you have a big year of capital losses, it's not wasted, but you don't get to use it all in that first year, which sometimes people get upset. It's like, oh, but I lost all of this. It's like, I understand, but that's the tax law right now. You can only take a $3,000 deduction, but it's not lost, because what happens is you roll it forward. Now, say the next year, after you couldn't use all of your losses and they roll forward, you have capital gains. Those losses will actually offset against the next year capital gains. So you can use them. You can harvest the losses, as we say. So it's not the best idea, but they're not gone forever and ever. So that's basically a quick summary of capital gains. Again, really important to the crypto investors, the real estate investors, the more traditional stock investors, but anyone who's buying and selling assets needs to keep this in mind. Have any questions? It's not the easiest subject, but at least we gave you an overview. If you have any questions, drop them in the comments below. And as always, if you have any more detailed questions, feel free to schedule a meeting with my office, and we'll see you next time.
Thank you for sticking around. I hope you learned something new. Please leave a comment, like, and subscribe to my channel if you want to continue improving your tax and financial literacy. Bye.